Holy crap, it's been a long time since I've made a video. But what's going on, everyone? Charlie here. Hope you're all doing great. Hope you're all having a good holiday season so far. Yeah, it's been a while. I've been very busy working on this application that I'm almost done with. Well, I say that, but I got a long ways to go. But I'm almost done to where it could be a useful application for the user. But that being said, I am going to go over a S&P 500 investigation real quick because a lot of things seem to be up in the air. There's a lot of bears out there still. They're slowly but surely converting over to bulls. And there's some developments that have occurred. And I wanted to go over what I think is going to possibly unfold here in the next couple of weeks when it comes to the S&P 500. So let's go ahead and take a look into this. And as you all know, I don't like to utilize technical analysis very much. Nothing against it. It's just, in my opinion, I don't find it a viable way to consistently make money in the markets. If it was, then you'd see a lot more success than you do in the markets. I'm more of a data guy. I like to go off of data analysis, data visualization, utilizing some key metrics from data sets. So let's go ahead and take a look at what's going on with the S&P 500. So this is a spreadsheet. I went ahead and I collected all of the 503 or 4 tickers that are in the S&P 500, plotted them all out on this Excel spreadsheet. Amongst the data metrics that I have here, obviously the ticker and the security name, the industry and sector that the tickers belong to, the average volume for the last 20 days, the percent held by insiders, the percent held by institutions, the percent change in price within the last 4 weeks, and the RSI 14-day, of course. So what are we going to do with this data? Well, we're going to go ahead and we're going to just look at everything and see what's going on. So when we go ahead and we look at the RSI, or I'm sorry, the change in price for the last 4 weeks, this is the data that we come up with when visualized. As you can see here, as far as a performance perspective is concerned, technology was the #1 gainer in the last 4 weeks, followed by consumer cyclical, followed by basic materials, followed by healthcare. The lowest was energy, and then communication services was also down there as well. Energy was the only sector that saw a loss in value over the last 4 weeks, so that is notable to keep in mind. Now, moving on, the top 4 being technology, consumer cyclical, basic materials, and healthcare. We're going to go ahead and look at the average RSIs for all of these sectors as well. But just keep in mind, these are the top 4 as far as percent change in the last 4 weeks. But when we look at RSI, and this is the average RSI of all of the tickers that are in the sectors in the S&P, you have consumer defensive with a 63 average, healthcare is a 62, basic materials is a 62, and industrials is a 62. So almost the same top 4 that we saw in the percent change of 4 weeks, but one difference being industrials rather than the consumer cyclical. But as you can see here, every sector across the S&P 500 has an RSI on the overbought side of the market. None of them are overbought technically speaking yet, but they are pushing there as far as the overall average of the sector that's in the S&P 500. So that is something to take note of. So how do the next couple of weeks play out? Well, there's a couple of things that developed over the last few weeks, and one of the most notable ones happened on Friday. The job numbers that came in were very robust. Now, this is not good for the Fed. Now, the reason why, I hear it all the time, people get confused when the job numbers are good, but the market tanks. Now, there's a reason for this. So Congress and the Fed are a little bit at odds right now. Biden loves the fact that the U.S. gained 263 jobs last month. The Fed hates it because the Fed is trying to slow down the economy, or in other words, they're trying to increase unemployment, not decrease unemployment. They're trying to increase it because they want the economy to slow down so we can fight off inflation and we can stop the rate hikes. But the fact being that the numbers came in hotter than expected is not good news for the Fed. Good news for Biden, but, you know, it's Biden, so it is what it is. But the Fed, the ones controlling the markets, do not like this fact because they want the economy to slow, not grow. So that is my main concern moving into the next couple of weeks. Now, how does this play out? Well, I have a couple of scenarios in my mind. Now, the only plots I've done here is the gap support here at 38.59.89 and the gap resistance here at 4218.70. This is our little zone we're trading in. If you look at the RSI right here, it's nearly overbought. It's sitting at 50.50. Actually, that's a different date. Sorry, don't pay attention to that. It's a little bit higher than 50. So it's in the 60s, I believe. But anyways, not much room to go upside before we hit that overbought marker. Now, downside, we do have a lot more room, and eventually this gap will need to fill, obviously. So keep that in mind. The question is always the timing. So scenario one, what I could see happening is they continue the run up to hit the gap resistance here, maybe even fill it before we come back down. And the catalyst for the down move would be a 0.75 rate hike surprise due to the job numbers that we just discussed. Scenario two, they go ahead and just close it up and go ahead and tank the markets next week when there's no Fed events scheduled. There's nothing going on. It's going to be ghost town. Literally no events scheduled that are meaningful other than the inflation report that's supposed to come out later in this month. So not really a lot going on. So that is a scenario that could unfold for scenario three, which is choppy titties, which I didn't put on here, but is always another likely possibility. So the question is, what is the Fed going to do? Well, again, I think there's a little bit too much bears in the market right now to give them the downside move they want immediately. So this is a hard one to tell, folks. But the point is, data. Data, data, data. Data is king. So here's the logic behind this. Too many bears, likely upside before downside. Job numbers are higher than expected, meaning the Fed isn't happy, meaning possible 0.75 hike in December's FOMC meeting, which would send the markets down, and probably in a very quick fashion. So my thoughts is that we may see choppy titties until FOMC, and then a surprise rate hike could do it, or unless the CPI numbers come in way hotter than expected, that would also be another reason for the markets to tumble. Now, as far as upside, again, the market is operationally shorted, and the reason why the markets just ran the way they did the last 3 days is because we just got out of the short settlement window. And, it's not a coincidence that we run all 3 days of the short settlement window, and now there's really not much going on, and we could see a slow trail off, we could see going sideways, we could see upside to hit that gap resistance. The point is, you never know. No matter how much data you look at, no matter how much technical analysis you look at, that's the whole problem, is that there's never a way to tell 100%, which is why you always have to be watching for developments that help aid you in that venture. So as for right now, no clear indication as where we're headed next week. But, in my opinion, all scenarios are possible. The most likely, in my opinion, is going to be a downside move. Despite there being too many bears, I think the most likely move is going to be a downside move. The speed at which that happens, I'm not 100% sure of, but I do think that they're going to see a downside move. Because if we go ahead and just correct now, and then we run into the inflation and we get the inflation numbers good, followed by the standard 50 rate hike that the Fed was thinking, then that'll put us right back to where we are now, and we'll continue on to maybe 430, maybe 500 by the end of the year. Who knows? But again, this is just to give you an idea of my thought process, what I'm thinking, what I'm taking into account. The next short settlement window is right around the FOMC meeting, I believe, or shortly after that. So that will be a factor as well. So just keep all these things in mind. And short settlement window, you mark your calendars. That shit's important. Very, very, very important. So, yeah, I mean, this market is right now a very, very difficult moment in the markets right now. There's a lot of bears, but they're slowly converting. That doesn't mean, technically speaking, that the market won't tank next week, but just be alert. Watch these Fed numbers, everybody. They're important. These job numbers, they're important. These PCE and CPI inflation numbers, they are important. These FINRA short settlement dates and windows, they are important. Over anything else, those are the most important metrics to watch in these markets, in my opinion. But one more bonus picture for the group. This is the S&P 500 RSI charted. That's all I'm going to say. You know. You fucking know, guys. Just look at the bottom of the picture. You know where to look. You know where to look. I mean, I'm holding.